Day traders, I trust you are all well and welcome to this week's show. Now, I'm sure you're all going to enjoy this. I'm just taking a different tack on the markets. Now, one of the things that I've been working pretty diligently on is to identify when the strategies I trade are okay in a particular. Sorry, someone, can you hear me better? I hope you can hear me better. Apologies for that. So I've been working quite hard, as I said, on looking at where my strategies form and how I can optimize them in the marketplace. Now, I think you're going to absolutely enjoy what I got to show you. I had a look this morning on what took place in the Asian session. Now, what's the Asian session for me? Okay, let's talk about Singapore time. It is from 8 a.m., the Asian session morning, until 12:30. So Sing or Hong Kong time, those 4.5 hours. Huge opportunities. Now, the market will not always be like this, but you can be assured that within a given week, one of these patterns will form. So what I did is put up 6 markets, and you can see the 6 markets at the bottom here: Euro New Zealand, Euro Aussie, Nikkei 225, Hang Seng 50, Aussie yen, and New Zealand yen. Now you can see they are in pairs of correlation. So Euro New Zealand is correlated to Euro Aussie, Nikkei 225 is correlated to Hang Seng 50, Aussie yen to New Zealand yen, which means you look at all 6 markets, but you're not looking to trade all 6 in a flurry. You're just looking at pairs. So if Euro New Zealand sets up cleaner for you, that's what you trade. So both. If it's Euro Aussie, you pick one of the two and one of the two. Now, this was absolutely fascinating for me to see how this unfolded. Let's have a look at it and just take you through. So this is Euro New Zealand. This vertical line is 8 a.m., okay? And right from that time, the market did enough breakout pullback, high 1 or high 2, you would have entered here. Now, these strategies probably hear me speak about quite a lot. They are in the best price action strategies course. So if you haven't attended that, get hold of James or Marlon in the office. They can assist you. So they would have been a perfect entry. And I have just marked where the stop would be. That's where you put the stop. And the market broke out beautifully and went above the high of yesterday, green line, high of yesterday. There is an opportunity for you to scale into the market. Okay, so the market is going up. You don't know what's going to happen, but it's clearly going up. So you got to decide where the stop goes. And that is where you'd have put your stop. At that point, that stop would be the same place where if you had taken the first trade, you'd have trailed that stop to break even. So you're not increasing your risk. That's something to bear in mind. That's now at break even, and you are trailing up. And the second entry is there, and say, okay, let's see what happens. The market reverses and comes back and stops you out. You're still only at the original risk, which would have occurred anyway, had you been stopped out much earlier on. We then had a beautiful breakout and a pullback. And the guys who follow my price action would have jumped into this straight away. I mean, that's as clear as they come. And, your stop would be down here. And by that time, you pull that stop up to break even. So again, if this trade fails, you're only risking 1, the full risk. And at that time, you've already banked, some decent profits. Market continued to accelerate up. This wedge line here, I'm going to just take it off for now. This comes in later on. When the market is starting to reverse and you look to where the market has come from and you say, well, why are we reversing? Why are we changing here? Then you can pick up where wedge is. But at this point, huge acceleration, pull back, another opportunity to get in the market. Well, market is going up. That stop is a break even. You can take another trade. Okay, so that stop is a break even. I mean, all of this is now bank profits. Still don't know how far the market is going to go up. Market accelerates up. And eventually we start to go sideways. And as we go sideways and break beneath here, your trail stop would have been it. There's many ways to manage the different stops, but the most classic and most straightforward way is just below the higher lows. Break even as soon as you can get to break even, and then beneath the higher lows. Now, if the market is going up and now it starts to reverse, at what point do you say it's time to bank all the profits? There are some things that if you do think about as market is going up, you don't have to stress about it. If you don't, if it's going up, you got to keep trading. But you have a beautiful enough breakout here. Where did it start? I mean, you can see where the bull breakout started. Breakout. And there was a pullback. Okay. So if we say the breakout started here, up to here, and ended there, the market got exactly to that point. Now, you don't have to exit unless you're going away because you're doing things and you need to get away. Then you can set your take profit just beneath that. And if you want to see, you might just get there and bank the profits, you know. But if you have to go away and you're up here, well, of course, you just close your trades and go. Market did that, it pulled back. So that doesn't mean it's reversing. You know, it's just people taking profits. Then it accelerates up again. And at that point, you could look back and say, well, how far is it likely to go? And again, you don't have to be thinking about this as you're trading. But if you do think about it, it's quite, gives you an indicator. So now we have another breakout starting from here to there. So there is the next breakout. And you're wondering, okay, I'm going to take this trade. How far is it likely to go? You know, the first trade got to the measured move. Now, for the second trade, the bulls are expecting that we get to that leg one pullback, leg two. And, you know, we missed it, didn't get there, profit taken, and eventually start to get beneath EMA. Now, that EMA is a 10 EMA, by the way. That's my friends call it George 10, George's EMA, because that's the only EMA that I use. Now, here's the thing. When you start to get beneath the EMA, if you've been trailing your stop, you're going to get stopped out at some point, and that's perfectly fine because the market is in a possible reversal mode. Now, how do you kind of consider, is this thing over? That's when you can look to the left and say, well, what price action is there on the left? That could have given me hints that this market is likely to have exhausted itself and will try to do something else. So when you look, you say, oh, okay, we had push up here, second, third. 3 pushes up, that is a wedge. A wedge is a potential reversal pattern. So now, okay, so the bears are coming off that wedge pattern. Doesn't mean you're going to sell off. You could just go on the trading range and accelerate up. So you'd have had opportunities to get into the market. Now, you do not have to stress about taking all of them. If you can take all of them and manage them, that is perfectly fine. But if you just take one of these trades on a day like this, I mean, the reward is fantastic. Then later on, the bears start to sell off. There is another pattern that we look at, breakout, pullback, low one, sell here, stop below here. Down here, we get another setup, beautiful breakout, pullback, low one. By that time, that stop is at break even. You can take that trade, and if you hold a break even, probably you can stop out somewhere around there. Now, that is the thinking on trading this. I'm just going to show you Euro Aussie, and we're not going to have time to go through it, but you're going to see when I say they are correlated, and you just have to choose one. So you're watching both, and you choose one that's to you looks like, okay, I'm going to jump in here. Don't trade both. It is not necessary. Just manage one and scale it. There is Euro Aussie. Okay, so if we just look here, Euro Aussie's initial setup was slightly different to Euro New Zealand. Okay, full breakout, pull back. I one didn't trigger. We had a second entry trigger. Euro Aussie again from the same time, very strong breakout, pull back, and you could jump in here above here. Okay, you could take a breakout trade, stop here, or because if you moved up, you'll stop to break even. This is right at a break even. Okay, if you moved your stop up at break even, you would have been stopped out if you hadn't waited, which is perfectly fine. That's the logical thing to do. Move it to break even, get stopped out. But when the second entry comes, there you can take that entry and your stop is down here. Okay. If you want to buy above a low test bull candle and a strong breakout, which I would do, then you just wait and buy any of these bull candles. Okay. If you didn't do that, when you get this breakout, by now you surely have to get in. You've got to jump in. You have to get in, put a stop here. If you're hesitant, put a white stop, but you do need to get into the money. Then the rest of it, a bit different, but look at it. Bull trend. You jumped in here, Eventually, we start to sell off, and we're selling off a wedge, 1, 2, 3, double top, etc. I want to just look at what also happened on the bear side of the money. Aussie yen. That's when the market happened. No, sorry, that's the 8 a.m. marker that I'm talking about. 8 a.m. sync. Could sell here, immediately stop above there. Perfect trade that I talk about. You'll be taking breakout trade, stop above it, or you're gonna wait for the pullback. Now, unlike on the bulls, we had a decent enough, breakout pullback. Here we had a pullback in the form of a tight trading range. And when it formed, it's a huge bear candle at this time, but it's a legitimate pullback, breaking beneath a tight trading range. Put your stop above here. Had you taken the first trade, it's a break even. If you hadn't taken the first trade, that's the first trade. And then you can wait. There is a classic breakout pullback low one. You can sell there, stop here. Okay. And if you're trailing your stop, I'm not going to talk about that now. You would have been stopped out above here as you're trailing beneath candles. But then it sets up again with a decent enough big candles. You get a breakout pullback. It sets up again. You put your stop in the correct place. You take it and you trail it, and eventually you get up. And then when the market starts to go up, that's when you look and say, well, it's starting to go up, but is there a reversal pattern? Here's one of the reversal patterns. It's a wedge bottom, 1, 2, 3. It's also a double bottom. It's a failed breakout in the double bottom. You can buy that as a breakout trade, stop here. If you want to take the breakout trade, perfectly fine. You don't need to do that. Wait for this, and you were given a classic breakout pullback I1. You could have taken that. I would have taken that, but you can take that if you want to buy a bull candle. Put your stop here. First one will break even, and then you carry on. Now, correlation. Remember, very important. Looking at two markets, you're choosing one of the best. New Zealand yen had a similar structure, which you could have traded, beginning here. Didn't take a breakout trade there because it wasn't as clean as it was on Aussie yen. But there's a pullback. You can take that. You can scale in here. Breakout pullback low one. Fantastic classic trade that, or take that. And again, when the market reverses, you look to the left, there's a reversal pattern. Confidence you take it, or you wait for the pullback. This time you can get in earlier if you want, or wait. Now, we had a similar thing happening on the indexes, but because we're out of time, I'm just going to flash them up. Slightly different, I want to show you on Hang Seng. Beautiful bear breakout. The same kind of thinking where you traded. I would have waited for this whole breakout. There's a pullback simply because of the dodges that we had here. If you wanted to take a breakout trade much earlier, you could. Breakout pullback, you take that, scale in. There's another entry. When you start to go up, you look to the left, there's a reversal pattern. Hang Seng was slightly different, a little bit more complex to trade. There is the first candle, so the gap down, but ignore it. There is the 330 candle, the 930 candle. There's a candle. Breakout, the bulls did well, reversed it, and then we failed to break out above the high of the first candle. Then you can sell that, but you're selling a little bit of a complex structure. Failed breakout above the high of the first candle. Low test can wait for the bear candle. Wide stop. If you don't see it, don't even bother. Wait for something clearer. Later on, with a breakout pullback low one, pretty close to the low, of the session, but legitimate. Stop above here, and you'd have had to get out break even. And then you had, a couple of entries later on in the morning for you to jump in. Now, if that doesn't excite you about price action trading, I don't know what will. It doesn't always You're not going to get this every single day, but in a given week, one of these patterns, whether the bull breakout or the bear breakout, is going to occur. And if you just take one trade out of the multiples that I show you, I think you'll enjoy your trading much more. Anyway, this is it. So I'm glad. Thank you for joining us. So the Asian session has a plethora of opportunities for price action trading. Again, if you want to be on that course, get hold of Marlon or James in the office. Marlon, boss, thank you very much. And thank you. Appreciate it. Thank you, Anne. Thank you, Sui. Thank you guys for posting. Catch up later.